Have you ever wondered how a company can be making billions in revenue, yet somehow, when it comes to taxes, they barely pay anything? Or how a company reports record profits, yet crashes into bankruptcy seemingly out of nowhere? What if I told you that behind all these polished earnings reports, the flashy investor calls, and the seemingly strong balance sheets, there's a hidden world of finance? A world where companies manipulate their numbers, hide debts, and do anything they can to hide billions from the public eye. It's the stuff most people don't see, but it's happening right now. And the kicker? It's all legal, for the most part. But of course, sometimes companies go too far. And when they do, the consequences are devastating. Today, I'm going to walk you through how companies hide billions in plain sight. Some legally, some not so much. And the consequences when they do get caught. By the end of this video, you'll never look at a Fortune 500 company the same way again. Let's get into it. Let's start with the legal tactics, because this is where the vast majority of manipulation happens. And it's all within the lines of the law. Some of these methods might seem shocking, but they're not just common, they're often used by some of the world's most largest and powerful corporations. Now, take Amazon, for example. In 2018, Amazon made a record $11 billion in profits, yet paid zero federal income tax. How? Amazon, like many other multinational corporations, uses profit shifting, a strategy that allows them to legally funnel profits from high tax countries to jurisdictions with lower tax rates. Here's how it works. Amazon may report billions in profits from their operations in the US, but the company's intellectual property, such as software or branding, is licensed to a subsidiary in a country with a lower tax rate, like Ireland. This lets Amazon shift the profits to that subsidiary, and in doing so, avoid paying a significant amount of tax in the US. This practice isn't exclusive to Amazon. Apple, Google, Microsoft, and Facebook all use similar tax avoidance schemes. These companies can legally avoid billions in taxes, even though they're making billions in profits. And while all this is legal, it's really important to understand how these tactics distort the reality of a company's financial situation. And unfortunately, they're not just used by a handful of companies, they've become part of a playbook for corporations used across industries. But there's a line that some companies cross, and when they go too far and break the law, the results can be catastrophic. These are the stories that made the headlines. The companies that thought they could cheat the system without the consequences. And when they're caught, the repercussions are massive. Now, let's take Enron for example. In the late 1990s and the early 2000s, Enron was one of the most innovative and admired companies in America. It was a darling of Wall Street, known for its high stock price and its supposed success in energy markets. But the truth was far darker. Enron used fraudulent accounting practices to hide billions of dollars in debt and overstate their profits. They used mark-to-market accounting, which isn't illegal by itself, but they took that to extremes, inflating their earnings with made-up numbers and reporting profits that didn't exist. Enron's executives were fully aware of this fraud, and they kept it hidden for years. The company also created special purpose entities, SPEs, which are essentially off-the-books companies that allowed them to hide debt and risk investments. Enron was able to report record profits while simultaneously masking massive liabilities. When the truth came out in 2001, the company's stock price crashed, thousands of employees lost their jobs and life savings, and investors lost billions. Top executives were criminally prosecuted, and Enron's downfall is still remembered as one of the most significant corporate scandals in history. But Enron isn't the only example of financial fraud on a massive scale. Now, let's take Lehman Brothers, for example. Leading up to its 2008 bankruptcy, Lehman Brothers hit over $50 billion in debt through a practice known as Repo 105. Repo 105 allowed the company to temporarily move debt off their balance sheet, making their financial situation appear much better than what it really was. They would use this accounting trick at the end of every quarter, transferring debts to other institutions just enough to make it look like they're in better financial shape. Lehman was hiding massive amounts of risk and just pretending to be financially healthy until all this exposure became too large to cover up. When Lehman filed for bankruptcy in September 2008, It triggered a global financial crisis. And the company's collapse wiped out billions in value, as well as causing a ripple effect across financial markets. It was one of the clearest examples of a company taking on way too much risk and using fraudulent tactics to hide it. And then, of course, WeWork is another modern example of a company that crossed the line into fraud. The co-working space giant was initially valued at $47 billion before it filed for its IPO in 2019. When the prospectus went public, investors discovered that WeWork had overstated its profits, manipulated its growth projections, and ignored massive liabilities, especially concerning its lease commitments. WeWork had used adjusted EBITDA to mislead investors about its financial health, but when the true numbers came out, the company's valuation dropped by billions. WeWork's founder, Adam Neumann, was ultimately forced to step down, and the company's IPO was postponed indefinitely. It was a classic case of a company inflating its numbers, hoping no one would actually catch on, until they did. Now, these are just some examples of companies that crossed the line of breaking the law. But how do most companies get away with doing it legally? For the companies that use legal strategies to avoid taxes or manipulate their earnings, it's often a game of exploiting loopholes and using financial engineering to stay one step ahead. Now, these companies have entire teams of accountants, tax lawyers, and financial engineers whose job it is to push the boundaries, taking full advantage of gray areas in accounting rules, tax codes, and international finance. One of the biggest advantages that they have is complexity. Take corporate tax avoidance, for example. The average person has no idea how multinational tax laws work. Hell, most politicians don't even fully understand them. And corporations use that to their advantage. They set up shell companies in the Cayman Islands or Bermuda, shift profits to subsidiaries in Ireland, and take advantage of trade agreements that allow them to sidestep massive tax liabilities. And when someone does question their tax practices, they can just point to regulatory compliance. They can say, "We follow all the rules, and we pay what we legally owe," which is technically true, but only because they've structured their business in a way that minimizes how much they legally owe in the first place. The same applies to financial reporting. Companies can take advantage of creative accounting techniques to make their financials look better than they actually are. Now, there's certain things like aggressive revenue recognition, booking sales before they're actually earned, adjusted EBITDA games, removing key expenses to make profitability seem higher, or off-balance sheet liabilities, hiding debt in special purpose vehicles so it doesn't show up on financial statements. Now, there's regulators like the SEC, Securities and Exchange Commission, or tax authorities like the IRS, who can investigate companies that take things too far, but let's be honest, they're outgunned. Large corporations have the best legal teams in the world, and even when regulators catch on, cases can take years to resolve. And when companies do get fined, it's often a slap on the wrist compared to how much they've saved or earned through the deception. If a company avoids $10 billion in taxes and gets hit with a $50 million fine 5 years later, that's still a win for them. When they actually do get caught, the companies that go too far and cross into outright fraud usually get caught in one of three ways. First one is a whistleblower speaks out. This is what happened with Enron, when an employee named Sharon Watkins exposed their fraudulent accounting. 2. A financial crisis exposes weakness. This happened with the Lehman Brothers, where their risky debt manipulation was only revealed when the 2008 crash hit. And 3. Regulators step in when things get too obvious. We saw this with WeWork, where public scrutiny before the IPO led investors to pull the plug before the fraud could grow any larger. But even then, many executives get away with it. Think about it. How many CEOs actually go to prison? Not many. Even when the fraud is exposed, executives often resign, pay fines, or settle out of court. Meanwhile, thousands of employees lose their jobs, investors lose billions, and the public is left wondering how it happened. That's the reality of corporate finance. It's a game where bending the rules is part of the strategy, and only the most reckless players ever face real consequences. So what's the takeaway here? Well, first and foremost, this affects all of us. These financial maneuvers aren't just numbers on a balance sheet. They impact everything, from the economy, to government funding, to your own investments. When companies avoid taxes, governments collect less revenue, meaning less money for infrastructure, education, and social programs. When companies manipulate earnings, it creates bubbles in the stock market, leading to crashes that wipe out wealth for everyday investors. And when companies commit fraud, employees lose their jobs, retirees lose their pensions, and the public pays a price for corporate greed. And here's the kicker: these tactics aren't going away. If anything, they're becoming more sophisticated. AI and algorithmic trading are making it easier for companies to be able to move around money undetected. Things like decentralized finance and cryptocurrencies are creating new ways to shift assets offshore. And the game is evolving, and unless regulators catch up, the loopholes will keep getting bigger. The companies that understand the game best are the ones that thrive, and those that don't, well, they're the ones left wondering where all their money went. So the next time you hear about a company posting record profits or avoiding billions in taxes, just remember, there's always more to the story. And if you want to keep learning about the hidden side of finance, make sure to like, subscribe, and share this video with someone who needs to hear it. Thanks for watching, and I'll see you in the next one.